Ladies and gentlemen, we're going to follow on the clearing theme. We want to look really at how you can overcome the complications of establishing a clearinghouse in commodities or derivative markets. Very experienced panel to talk about the issues today. Again, I won't go with long introductions. We have Kesara Manchusree from the Thailand Futures Exchange, Rory O'Brien from LCH Clearnet, and Ireneusz Łazor from, I hope I pronounced that right, from the Warsaw Commodity Clearing House. Initially, we were going to do a sort of a TV style, and my first guest is, but I decided against that on the basis that we're going to much more fun having a conversation. You all have, I think, quite different, certainly different models of clearinghouse here. I think you probably cover all of the bases. Could you very briefly, in turn, just give us so everybody in the room understands what your position in the market is? Tell us how your clearinghouse is set up. Is it part of the exchange? Is it separate? A little bit about the structure. Kesara, can I start with you, please?
I'm from the Thailand Futures Exchange. What we do is we set up, because of we have the parent company called the Stock Exchange of Thailand. Stock Exchange of Thailand holds have the stake in everything. Because of it's Thailand Futures Exchange is 100% owned by the Stock Exchange. So the Stock Exchange set up another company called the Clearing House, and Clearing House is owned by the Stock Exchange 100%. So what we started, we start with we have the Clearing House, separate company, and do clearing for the future exchange. But after a few years, we put it the cash market clearing house into the same company, but just separate the fund because of, we have different members. But what we are planning is I think by next year we are going to do some kind of cross collaterals, or doing some kind of, because of we have the members who are being member of both the cash market and the derivative market. That would make the members easier for managing their collaterals.
I think the idea of putting the cash markets and the derivatives markets more closely together, particularly in terms of cash flow, is an important point, one we'll come on to later on. Thank you very much. Rory.
Good afternoon, everybody.
You have to do this lying down because you're a horizontal, by the way.
Ha! Well, yes. It's hard to me to say exactly who owns the clearing house at the moment.
Anyone put their hands up on that one?
Because, as many people know, we are subject to takeover discussions or conclusions with the London Stock Exchange. But even after, if that merger goes ahead, the intention is that we would remain as a horizontal clearinghouse, that is clearing for a number of different markets and pretty much the last gasp of the horizontal model in Europe. So as most people know, we have a very large OTC clearing in financial derivatives and in recently begun this week in FX and also in CDS in Paris. We clear a very large part of the bond market in Europe, which has been interesting over the last few years, and also for a number of the large exchanges in London and Paris, which is where we are most challenged and where the vertical market is coming to fruit with many of those exchanges saying they want to go vertical. And in addition to that, we clear a number of OTC commodity markets and power markets. The freight market where we do the clearing was mentioned this morning as a good example of one of the OTC markets that we cover.
Okay. I think we'll one of the things that sort of interests me and I'd like to look at a little later on is the move of the exchanges away from LCH, what that means to you in terms of being able to offer the full horizontal service, which in days gone past you really could do. And sort of how that marries up, do we see green shoots between you and NYSE given the announcement about the US tie-up?
I'm afraid really that is something I can not talk about, largely because of ignorance.
That's a very good answer.
But these debates about which markets are going to stay with us and which ones are going to go have been going on, to my knowledge, for the last 3 years and seem to continue. In addition, we are looking at new markets, and I think one of the advantages of moving to the vertical, if you like, for that segment with the LSE is that it does give us the opportunity to work with other markets, because they have been quite entrepreneurial in which markets they have been talking to and working with.
Yeah, and I suppose from an LSE perspective, it's you know they have to play as well. If they've got a vertical, their own vertical, regardless of what you're doing, it puts them in a better position.
Quite what they do when they realise they have now 3 clearing houses, and we're not quite sure. We'll see what results about that.
We put them on a shelf, you see.
Good afternoon, everybody. Warsaw Commodity Clearing House is quite new clearing house. Warsaw Commodity Clearing House established November 2008. 100% of our shares holds by Polish Power Exchange, so we are a daughter company for Polish Power Exchange. But interesting is, let's say now we are on the Warsaw Stock Exchange group, because 91%, if I remember correctly, 91% of Polish Power Exchange holds by Warsaw Stock Exchange. So now is the one exchange family in Poland. So now we on Warsaw Exchange family. But our business, we are concentrated only on the energy sector. We clear electricity transactions, spot and forward, and we are now on the way to open gas market in Poland. So we are focusing on the electricity sector. We have 51 participants, 51 clearing member. It's brokerage houses, generators, distribution company, Polish and international. For example, our members comes from France, Germany, Denmark, Sweden, UK. So that's a very short brief where we are.
Interesting. You know, the power clearing is a very capital intensive activity. You know, I'm sure you have the same members of your clearinghouse as ECC and Nord Pool Clearing or any other of the major power clearing houses. What are you doing? Are you doing anything with the other clearing houses to be able to provide offsets to maximise the value, given that the value of power in one place or with another is not perfectly correlated, I grant you, but is there anything you're being able to do to offer capital efficiency?
Well, not yet, because electricity is one of the commodity which not so easy to transfer from a country to the country if we are talking about the spot. So yes, we have international players, but well, they must concentrate country by country. So well, we Warsaw Commodity Clearing House is a member of each, for example, but our collaterals, our risk management is domestic. We are focusing only on the electricity market, but of course we are looking for some international links. But for us, because it's so we have the problem, let's say, with the international players. What do I mean? It's the VAT problem, because it's not so easy. It's one of the big problem on commodity market, and especially in electricity market. It's not so easy to transfer under the EU regulation. It's not so easy transfer VAT under the border. So for us, this is a problem. It's a so huge problem. If volume goes up So for the clearing house, for our clearing house, but generally for a clearing house which cleared the electricity, it's a so big problem.
Okay, thank you. Rory, Kesara, I want to talk about, I'd like to a bit from you on the effects on your organisations of the MF Global default. You know, what fundamental changes are happening within your organisations? Don't mind which one of you goes first on that.
For us, I think for MF Global is because of most of the transaction is just local.
Mm-hmm.
That's why MF Global would be a lesson learned for the regulator size. And I believe that our regulator has been follow all the Western regulation. Like we do have because of, under our law we have the segregation of the client funds. And I think recently the regulator just spell out that that segregation of fund that which are client of asset they can put the money into. So it has to be liquid and sovereign risk, and the regulator keeps checking up where's the money.
So, you know, I mean, this is an element I wanted to get into, the idea of segregation and the levels of segregation. So what level of segregation do you provide? Do you provide full account segregation, so collateral, any margins, any cash, positions themselves, or do you segregate certain parts of it?
Under the current regulation, it's with segregation the clients and the house account, and we do the cross margining.
Mm-hmm.
So every client cannot offset together. So the brokers need to maintain like individuals clients account, and the clearing house we collect the margin. Like we collect the margins one times, and the brokers can have post the margin about 1.9 times. So broker would have about 90% at their pockets. But this one need to segregate also. Okay. And the clearing house requires all the broker to submit that like the single position of each clients. So we know, and this one I think so far that the regulator has been talking to the government agency for like how to do if any things happen, if any brokers got bankrupt or anything. So they start talking what could be the process, because under the law we already spell out that this segregation of fund cannot be go to like when they have the bankrupt. This one will segregate out and can be returned back to the customer within the 30 days.
Yep. Okay.
So.
Rory, I think this probably could take an afternoon, but
yeah, well, I was going to say first of all that for LCH Clearnet, the MF Global default was perhaps not as traumatic for us as it was for the market, because we had suffered and learnt from the trauma of the Lehman's default, which was the one that left us with trillions of dollars of swaps positions to dispose of, and we learnt our lessons then, and so the processes were in place for MF Global. So although difficult, it wasn't it was taken much more easily by the clearinghouse. I think in terms of looking at the issues of collateral and margining, the area that I think is causing us most to debate in-house is the global position and the differences between European and American regulation.
Yeah. With regard to bankruptcy legislation, is that?
Yes. Yeah. Because to some extent the regulation is conflicting, the models are different, and if you look on you have a global financial market, say in interest rate swaps, which is now trying to be regulated on a regional, i.e. America versus Europe, and that is causing us strains that we would not like, and forcing us to consider models which we would not consider ideal to split. But we're so considering the splitting of default funds and consider other methods which we would prefer not to do in order to meet with regulation in the two jurisdictions and thus keep the market position we have.
And presumably the splitting of default funds then means higher costs for the market users, right?
Yes.
I mean, all of it, I assume. Well, the other part of this is that I understand from discussions with market participants that you're also looking at the full segregation or a graduated segregation model.
Yes, there is really considerable work going on in this whole area from different asset classes we're looking to take in as collateral to get over the credit crunch that we were talking about in the previous discussion, and to a complete afternoons full of discussion of measures we are considering, but all done from the purpose of trying to maintain utter security in the market.
So presumably, let's talk about incremental cost. Are you going to put, how are you going to decide how much each of these different services costs? Is it just what you can get away with, or is it, how will you decide?
It's certainly not what we can get away with. It's really effectively what we are under constant pressure to keep the costs down. We learnt that in the exchange business, and we certainly learnt it in the OTC business. And it is the seesaw of a clearinghouse of the desire to keep the collateral levels down and the charges down at the same time as maintaining security. And in LCH Clearnet, we always lean on the side of security. And in the previous, I was listening with interest in the previous debate when Mr. Bellchambers was talking about the possibility of putting skin in the game, and was sitting back thinking, yes, well, it's all very well if you should have skin in the game, but what if 1, 2, 3, or a domino effect of companies go down, and we still have to clear the lot of them?
Yeah, but that's part of your stress testing, surely.
Yes, it is. But then that's what the margin we take. So we tend to err on the side of caution.
Okay, fair enough.
Lucky because we are under the two bodies regulation, and two bodies looking for us. One is the financial authority, second is the power authority. And of course, in two acts, I mean trading rules, MiFID on the one side, on the second is Commodity Exchange Act, is our domestic regulation. We see a lot of some conflict.
Yeah.
But of course we do segregation of our members, because for the left side, for example, we have baseload power plant station, let's say on the very, very high situation of his financial position. And on the, let's say, opposite side, we have small traders. So of course it's a big gap between margin of those two companies. But we think it's by the segregation of margining, depending of financial situation, of sizing of our members, our market is quite liquid. So and of course, it's for the second. For the first, we are always looking for safety and proper margining. I mean, whole risk management system.
Sure. I mean, it's very interesting. Obviously we have very differing styles and sizes of clearinghouses represented here. Rory, start with you on this one, and then to your colleagues in the panel. Do you think the smaller clearinghouses will be able to survive? Given the importance of of offset of risk, of trying to make things cost efficient, surely size is really about the only thing that does matter at this point.
No, I very much consider that these smaller clearing houses will continue to exist in specific markets. We've already heard about the problem with VAT in your market. There's also in other markets are entirely restricted by national regulation and closed borders, which mean therefore that they can the larger the clearing houses can't get in. We have the problems of the cross-border transfer of funds and the fact that that can't do. I was listening to the interesting idea about trying to take collateral from Romania to CME and back again, and thinking, yes, nice, but I don't know how you could do it. And I think they'll be around. To stand your point on its head, rather, what we are learning as a clearinghouse as we are trying to expand our business is that there is a wide range in markets. We are trying to provide clearing services to OTC markets and as well as to the largest exchanges and the global OTC. And we are very much trying to change our model so that we can meet each one with the size and the degree of security that is appropriate for that market. Historically, we've tended to use a one-size-fits-all and a very similar model, which tends to get very expensive for the smaller markets. And we think that there are differences of the models you can apply, the services you can give, the reporting you can do, and that will therefore make clearing more cost-effective. So in some ways, we are trying to copy the model of a small local clearinghouse in order to make ourselves as competitive as that model.
I mean, I suppose one could argue that given that there's a sort of one global leading algorithm in terms of margining, which is SPAN, that probably constitutes the biggest risk to the markets, because the response from each clearinghouse in the event of a shock is almost identical, because SPAN works in the same way everywhere.
Yes, though increasingly for our overall market calculations, we are moving on to a VAR basis for our comparisons between markets, and we are looking at other models as well. So I'm not sure about quite how long the SPAN model will continue.
Yeah, I mean, it's quite prevalent that, you know, the demands for that in the power markets, for instance. Now, Kesara, you were talking earlier on about the potential for an ASEAN grouping. Do you see that manifesting itself in terms of an ASEAN, pan-ASEAN clearinghouse for the whole region?
What I'm guessing, because as you already seen that from the stock market itself, I think it would be very difficult to have one single stock market. That's why they designed to have a kind of linkage between each other. And for the clearinghouse, it would adopt pretty much the same. That if they could, there's some kind of linkage. One clearinghouse like Thailand Clearinghouse might be, this is under what their consideration, might be going to be kind of a member of like SGX or Bursa Malaysia or some other things, and clear for the brokers. This is one option. Or if they might let each brokers of each country to be a member of that own clearinghouse. So I think they are working together that which model should benefit to both local and the foreign investor.
Okay. Now, this is a wide subject. We've had quite a lot of discussion. Is there anybody got any questions before we proceed from the room? Fred? Just hang on, just if you could wait for the...
More a question for the capital structure of the clearing houses. I don't know what that was. A question about the capital structure of the clearing houses. Mostly for the smaller and newer exchanges and smaller and newer clearing houses, but it also, I think, applies to LCH. One of the common questions I always get as far as the guarantee funds and the capitalization of a clearinghouse, and I'm talking about beyond the day-to-day margin requirements. And it's a simple question, but it's how much is enough? And I know you can tell me all about stress testing and these kinds of things, but I look at the Thailand exchange or the Poland exchange, you know, how much is enough? If I look at LCH sold for what, 400 million pounds or somewhere in that vicinity, but I would bet that the risk going through LCH on a daily basis is far, far greater than 400 million pounds. If I look at the Chicago Mercantile Exchange, they're probably capitalized at, well, let me say 20 billion US dollars, but that's something like 20,000 Eurodollar contracts going in and out of the exchange every day. So. Yeah. I guess my simple question is how much is enough? And as I look at these new markets trying to get up and operating, you know, they ask me the question, how much money do we need in the guarantee fund or the capital of the clearinghouse? So what should we be telling them?
I think, I hope I'm not going to be shot by my lords and masters, but...
So I won't tell them.
Yes, thank you. But to be quite honest, the capital of the clearinghouse would go nowhere. The amount of risk going through LCH on a daily basis is into the trillions of dollars, significantly into the trillions of dollars, and the if the margin and the calling after that, the levels of collateral are not sufficient, then the capital of the clearinghouse would not go very far at all to meet any of the requirements of that.
So what you're saying is effectively putting skin in the game is pointless.
It is in the game because it would be risk, but it just the capital would not go far against the size of the risk that we are managing.
Sure.
Now, with the Lehman's default, we were able to resolve that within the margin that had been given by and return margin to the undertakers of the Lehman business, but you might argue from that perspective that, well, maybe you were taking too much margin in that regard and should have taken it further down the line. But it's a nice balance to have, and we always on the side of caution, because once you go beyond the initial margin and getting into calls on customers who are themselves under stress at that time, and then into the collateral of the clearinghouse, it is a very steep slope towards the failure of a clearinghouse, in which case if the London clearinghouse fails with a single default fund, then it's a catastrophic on a scale which we just haven't experienced yet.
Well, I mean, at that point, you're probably talking about a global catastrophe in terms of other clearinghouses, aren't you?
Yes.
Okay, our initial capital, it's 4 million euro. Net profit 2011, it's 2.5 million euro. Open interest for electricity forward market, it's now 8 billion euro. And margin, maybe that way, guarantee fund, it's 24 million euro. So how much money we need? Well, it's a good question. I don't know yet, but of course, if we're looking for, let's say, each level, so for CCP, it's a minimum initial capital is 7 million euro, but power exchange clearing houses, it's a good question. What does CCP means? It's a completely different story if we compare to equity market. Because of what? Because of volume of market and role which clearing house playing in this process. Because clearing houses on electricity market, we are seller for buyers energy, and we are buyers for a seller. But what does it mean? It's only tax procedure. Of course, we are not buying energy. We are between seller and buyers, but on a let's say tax procedure, we are for a moment we are owner of energy. So what does CCP means? What we are looking for regulation on the electricity energy market? We are on the beginning of this way. But if I may add one comment to your last question, you know, electricity, I wouldn't talk a lot of energy, but before I add something, I must explain one thing. Future for power exchanges for electricity, writing down by the European Union, is the common market from Finland to Morocco. Morocco, because Morocco is connected with Portugal and Spain under the sea, cable under the sea. So one market, one price from Scandinavian to Morocco. Some important role in this project must playing exchanges and clearing houses. So that way, in this part of business, in my opinion, we are on the way to cooperation for sure between clearing houses, maybe one big clearing house in European Union. So in my opinion, it's a very, very close future in this part of business.
For the Thai market, I believe that we has been, I think we has been consult him when we start the clearing house, and I think all kinds of margin that we has been imposing to our broker is all the kind of starting from the margin and the like we have like super margin for the long weekend. We have extra and we mark to market every hours, so we can call for the extra margin. But I believe that so far that we has been operating for almost 7 years. We keep watching the strengthening of our brokers on the financial status, and we explore and we monitor it all the time. That because of, I think if our members bankrupt or anything happen to them or fails of the trade, we would get any effect on it. I think so far we got only one technical problem because of the bank doesn't transfer the money at 9 o'clock in the morning time, so we cut it off. So we don't let them trade, but it's just half an hour they come back. So we have to wait for another session to let them come back. I think as we see that our risk management and procedure, we believe that it has some kind of enough for the present situation. But if anything really happened and we couldn't forecast it, I think what we have it, we already spell out that what we have it and what the exchange already reserve, because of the stock exchange who is own this kind of business. We reserve about like, I think about $100 million to do things. But if anything happen, I think it's just that we have it. And I believe that as a small exchange and as a kind of we have only one in the country. I believe that the existing regulator would have to come to see that how could we resolve the problem.
I have to say, I think probably the answer is that I don't know that there is enough, not in the leverage market, but I don't know that any better than anybody else. But I'm aware that we're getting close to tea. There's one last question I do want to ask the panel, but I will defer that if there's anything burning from the audience that anybody wants to talk about. Okay.
One burning from the panel.
Okay.
And only the point to continue on from your point about a single clearinghouse in Europe. And yes, I can see how that would occur in the power market, and this was part of the conversation I wanted to have with you. But in the other markets, it's much harder to envisage, and then it's related to the first question about the survival of small clearing houses. As you are aware, the LCH has gone into a model of interoperability with
You've just gone on my question, so
I'm
carry
sorry.
on, that's brilliant.
Interoperability with other
excellent.
clearing houses, but to be quite honest, that is a nightmare to set up and extremely difficult to get the regulators to approve, and for the whole issue of margining across the clearing houses. Yeah. There is another model which we are looking at the moment, which is whereby there can be a hub and spoke model, whereby a number of small regional clearing houses, you could imagine, say, this might apply in a developing market, where small regional clearing houses would have a relationship with a large central clearing house, but that would be on a sub-CCP or a central CCP, so the flow of collateral was only one way. So effectively the local clearing house would be supported by the central clearing house. And that, as an alternative model, allows the local clearing house to survive, to actually support its local market and its local brokers while still having a relationship. It also allows international banks potentially to keep the relationship with a central clearing house and yet work in a local market through the chain of clearing houses.
And that's not dissimilar to the way that Eurex work with ECC, is it?
No.
It's something that does, it's a model that is tested and does work. So.
Yes, and I think that is rather than the threat of Big Brother of one enormous clearing house, which itself has systemic risk, the model of clearing houses where there's individual ones, but there's then a central support, perhaps has a lot to make it worth investigating for some markets.
Absolutely. Ladies and gentlemen, it's tea time. Thank you very much for your kind attention. I'm sure the panellists would be very happy to answer any further questions over tea. And we'll see you back here in 20-25 minutes for the final panels of the day.